Hey everyone, so my name is Zach Vines, and what I want to go over today is just a very brief explanation on deferrals in your principles of accounting classes. So by the point you've gotten to deferrals, you've probably heard of accruals, which I have another video, just accrual accounting explained, that I'll put in the description. But essentially, the notion of accrual accounting is that we only recognize revenues whenever we earn the revenue itself. So we provide our service, we sell our product, everything's said and done. That's when we recognize the revenue regardless of when we get the cash. And expenses are incurred whenever you recognize the benefit of the service that you paid for, you receive the product, whatever the case may be. So in those situations, the cash actually comes later because we can perform the service, we can sell the product, whatever it is that we're doing, but we're squaring away the cash kind of on the tail end. It's like putting it on our tab. So definitely check out the Accrual Accounting Explained video if you're still worried about that. But as far as the deferrals are concerned, it's the exact opposite, just meaning that the cash comes first in deferral accounting. So pretty much it's best illustrated by an example. So the example I'll give you right here is that I'm paid, let's say someone pays me $600 up front, goes, hey Zach, here's $600, mow my lawn for the next 6 months. So they're essentially paying me $100 a month to mow their lawns. So I get their cash, but I haven't mowed their lawns yet. And because I'm apparently in the business of mowing lawns, I'm not going to recognize the revenue associated with that until I've actually mowed their lawn, until I've performed that service. So it's a deferred revenue because I'm paid now, so the cash comes first, so remember that, but I haven't yet earned it. So essentially the way you do these journal entries for it is that, let's talk about when I first paid the cash. When I receive $600 cash, I have $600 cash, so I need to increase the balance in my cash account by the full $600. And I'm not going to recognize the revenue yet because I haven't performed the service. So based on this nature of accrual accounting in this deferral situation, I can't recognize revenue until I've earned it. So what I do instead is increase the balance in what we call an unearned revenue account, which is considered a liability. Essentially saying that this is your running tally of the value of services you still have to perform for people. You're liable to perform these services for people, hence why it's an unearned revenue liability. So when you debit and credit it, you just simply debit cash because you increase an asset by debiting it. Then we credit unearned revenue because you increase a liability by crediting it. And then finally, as each month goes by, so this represents as I mow their lawn once, I mow their lawn twice. This is the journal entry that happens every single time on that. So once I mow their lawn one time, I've now earned part of that $600. So if they're paying me $600 a month $600 overall for 6 months, that means I'm earning $100 each time I mow their lawn. So once I earn it once, once I mow their lawn one time, I increase my revenue by the amount of value I pretty much provided for them, by that 1 out of the 6 lawn mows that I perform for them. So I increase my revenue by that $100 and I'll decrease my unearned revenue because I'm essentially taking it out of unearned and putting it into just earned or just regular revenue. You call that service revenue, whatever the case may be, but the point is that you have now earned it, you can put that on your net income, and you have now effectively earned that revenue. So we're going to debit unearned revenue because we're reducing that liability, so you debit a liability to reduce the balance in it, and then we're increasing our revenue account, and you do that by crediting it. So that's pretty much the short story of it for the most part. I mean, as each month goes by, you're going to debit unearned revenue, credit revenue each time. By the time you perform the full service, you're zeroed out to where you have nothing remaining in your unearned revenue. So with deferral accounting, the cash comes first, remember, and it's almost always going to entail unearned revenue, which becomes earned revenue as you earn it. So thank you for watching, and I hope that helped.